Speaking of bull call spread, you may wonder where we got this graph from. In this video, I will demonstrate how this graph is constructed in a synthetic way. The definition of a bull spread is quite simple. We short a call at a high strike price and we long a call at a low strike price. In order to understand this graph, we can separate this graph into three segments. The first segment, neither options are exercised, because the price is lower than the low strike price. In the second segment, the long call option is exercised because it has a relatively lower strike price. In the third segment, both options are exercised. When combining these two graphs, we get the following graph, exactly like the one in our PowerPoint. Now you may wonder, why does the graph combine to be this squiggly line? Let's return to the original graph and look at the first segment. In the first segment, neither options are triggered. So the payoff would be the difference between two option premium. And the two option premiums are different because they have different strike prices. In the second segment, the short call option has not been exercised yet, whereas the long call option has been exercised and is making money. Hence, we have a positive linear trend in the second segment, meaning that this combination is making more profit. In the third segment, one is going up, one is going down. Hence, we have a locked profit. Now, let's get into the profit and loss. In the first segment, as I said earlier, neither options are exercised. Therefore, the profit is the difference in the option premium. In the second segment, the long call is triggered. So the payoff is the stock price minus strike price and minus the long call option premium. The short call option has not been triggered, so the payoff is still a positive option premium we get to keep. By combining these two, we get the final profit for this segment. We do a similar computation in the third segment, whereas two options are both triggered. In simple terms, the payout in the third segment is the difference in strike price plus the difference in option premium. Knowing all this, let's put our knowledge into test. We are building a bull call spread using the $65 and $70 strike option. And the question wants us to compute the maximum profit on a per share basis from investing in this bull call strategy. How should we do it? In this strategy, we are going to long a call option with the strike price of $65. And we're going to short a call option with a strike price of $70. And the maximum profit is exactly how we computed in the third segment. The first step is to compute the difference in strike prices, which is $5. The second step is to lock in the difference between the option premiums. In this case, we use the short option premium to minus the long option premium. In the end, we get the answer is 2.26.